Welcome. Today we're going to cut right through the noise. We need to talk about the AI landscape, specifically this massive gap that's opened up between the money pouring in and the real-world value coming out. It's a disconnect that every single executive, founder, and investor has to get their head around, and we're going to break it down right now.
All right, so here's our game plan. First, we'll unpack this idea of the price of a dream that's really driving the market. Then we'll get into the hyperscalers and why they have such a huge structural advantage. From there, we'll hunt for a real defensible moat in this space. Then we'll hit what I call the diffusion problem and wrap it all up with a look at the consolidation that I see as the inevitable endgame here.
So let's start with this core contradiction. The market, right now, is valuing AI on its potential, not its current productivity. We're seeing these astronomical valuations based on a future that, frankly, just isn't here yet. And that creates a very, very interesting and, I'd say, pretty risky dynamic.
And this quote just nails it. You see, the critical thing to understand is that almost all the AI spending today is capital expenditure. It's companies buying GPUs, building massive data centers, scaling up their cloud. They're spending on AI, not getting productivity from AI. We're still in the build-out phase, not the value capture phase. That flywheel isn't spinning, not yet.
Now, this slide, this really puts it all into perspective. Just look at these numbers. On one hand, you've got Minimax, an AI lab. They're projected to do about $79 million in revenue while losing over $500 million. On the other hand, you have JD.com, an e-commerce giant, pulling in over 150 times billion dollars in revenue, and they're profitable. And yet, the market values them at the exact same $40 billion. It's just staggering. That's the price of a dream right there.
And this is what we're talking about, the price-to-dream ratio. That 500x, that's roughly the trailing revenue multiple for a company like Minimax. You can't even talk about a price-to-earnings ratio because, well, there are no earnings. The market is pricing in a dream, 500 times bigger than current reality. And that dream is burning cash like you would not believe. Now, okay, not every AI company is a Minimax, of course not. You've got the leaders like Anthropic, and they are generating real, substantial revenue. They're on a path to a huge IPO. But even they are trading at a premium 13x revenue multiple. It's still expensive for sure, but at least it's anchored to something real. They've actually found product market fit, and that makes all the difference in the world.
So this begs the question, who are the real power brokers in this new economy? It's not the standalone labs. It's the hyperscalers. They have a fundamental structural advantage that's almost impossible for anyone else to compete with.
And each of them is playing a very smart, very rational game based on their core business. Microsoft is all about integration, getting Copilot into everything. Google is going fully vertical, from their own chips all the way up the stack. Amazon is making a pure platform play with AWS. And Meta? Meta is trying to commoditize the model layer itself to prop up its core ad business. But here's the one thing they all have in common. They can afford to lose billions on AI because it feeds their profitable core businesses.
And that's the harsh truth for any independent lab or investor out there. You're not just competing on whose model is better. You're competing against these massive ecosystems that have incredibly deep pockets and play by a completely different set of economic rules.
So this leads us to the most important strategic question for anyone building or investing in this space. If foundational models are basically becoming a commodity, what's actually defensible? Where can you build a real durable moat?
Well, just selling API access is not a long-term strategy. It's already a race to the bottom on price. The margins are just going to get squeezed to zero. The real value, the defensible ground, is in building sophisticated, autonomous agents, AI that can actually perform complex, multi-step tasks. That is much, much harder to turn into a commodity.
So beyond these agents, where else can you build a moat? I see three other key areas. First, security. Using frontier models to find zero-day vulnerabilities is a huge one. Second is compute. Just having access to massive leading-edge compute is becoming a gigantic barrier to entry. And third, and this might be the biggest one of all, talent.
At the end of the day, you can have the best architecture and all the compute in the world, but those are just table stakes. The single biggest differentiator is talent. Having the handful of researchers who can operate at the absolute frontier of this field, that is arguably the most durable moat in this entire industry.
Okay, so let's say you've done it. You've built your moat. But there's another major hurdle that the market narrative tends to just gloss over, and that's the huge gap between what AI is capable of and how much it's actually being adopted in the real world.
It's a real paradox.
While the US is, without a doubt, the leader in creating the core technology, the infrastructure, the models, we're actually falling behind smaller, more digitized economies when it comes to embedding this stuff into actual business workflows at scale.
And let's be crystal clear about this. Those massive valuations we talked about, they're all banking on productivity gains. And those gains only happen with widespread adoption. Building the tech is just step one. The real economic value is only created through diffusion, and right now, that's happening way slower than the market seems to think.
So, you put it all together. The insane cash burn, the hyperscaler advantage, the slow pace of adoption, and it all points in one very, very clear direction for the future of this industry.
The economics are just brutal. The cost of compute and the salaries for top-tier talent are astronomical. Without a hyperscaler as an anchor, it's pretty much impossible for an independent lab to survive long-term. The math simply doesn't work if you're only relying on API revenue.
The Microsoft OpenAI deal, that was the template. And now we're seeing this hybrid alliance model become the blueprint for the entire industry. It's a powerful, simple formula. The research lab brings the cutting-edge capability, and the hyperscaler brings the distribution, the compute, and the monetization engine. This is the model that will drive all the consolidation from here on out.
And so this brings us to the final critical question, the one every founder, executive, and investor needs to be asking themselves right now. The dream is absolutely real, but that dream has a very real and a very high burn rate. So who survives when the capital runs out? Can this incredible potential actually translate to economic reality before the funding and the patience runs dry? That's the multi-trillion-dollar question that's going to define the next decade of this industry.